Welcome to the Gravity Well podcast with me, Jenny Yeremy. I host the Gravity Well to celebrate and share the stories of people looking to empower others with the knowledge and skills required to reestablish stability in our communities. My mission is to work through heavy issues in conversation and process in order to lighten the load. I acknowledge that I live on the traditional territories of Treaty 7 and Métis Districts 5 and 6. The treaties and self-governance agreements established by Indigenous peoples were created to honor the laws of the land, maintain balance with nature, and give back to uphold reciprocal relationships. This knowledge and intention are what guide the Gravity Well conversations. I ask for genuine dialogue, real hearts, and openness to different perspectives. This is your invitation to find common ground with me. Positions taken by participants, either individually or collectively, do not necessarily represent those of the Gravity Well. This podcast is dedicated to the natural world, our children, nieces, nephews, grandchildren, and all future generations. The Gravity Well is on YouTube and streaming wherever you get your podcasts. If you like what you see and hear, remember to like and subscribe. Good afternoon. I am Jenny. I'm broadcasting from Calgary, Alberta. I'm a geophysicist and oil and gas liability expert turned public activist and host of this podcast. I am here to help cut through the pollution and populism by addressing the propaganda that we see in our province, in the media, and in our government. Please remember to like and subscribe to the Gravity Well. Your doing so helps boost the voices and views of the stellar people who are bringing forward these really important issues for us. Please mark your calendar, Calgary Beau. Markham Hislop is going to be coming to town on Friday, April 24th. He and I will host a dual podcast in person at, we're just settling the location. I will be bringing forward the phase 2 of my plans post the Recall Nicolaides campaign in Calgary Beau. So you can hear about what I'm working on, how I'm trying to collaborate with the people that were involved in the Recall Nicolaides campaign and the other recall campaigns beyond that. And remember to go to operationtotalrecall.ca to support the recall campaigns that are happening still. My Midas Canada interview with Thomas Lukasik is out. It's called Albertans Fight Mega and Defend Canada. My favorite part is around 19 minutes where Thomas explains the absolute impossibility of Alberta independence physically, economically, and practically. Yes, it is only one market that we would be left with, which is the United States, and we would be absorbed by them instantly. Please check out that conversation. Thomas does a brilliant job, the entire conversation. And remember to sign up for their newsletter to get involved in the next phase of that campaign. So that's at forever-canadian.ca to get involved in that. Also, become a canvasser for the waternotcoal.ca campaign that's underway. I'm looking to have a couple conversations around water not coal coming up. I'll let you know about those soon. And I'm really enjoying meeting the people that I am that are taking their time to come to my place and sign the petition with me. Again, go to waternotcoal.ca to sign or to become a canvasser. The more canvassers, the merrier, the lighter the load for everyone taking on this important issue of stopping coal mining in the Eastern Slopes. As I mentioned last week, the Coalition for Responsible Energy is hard at work. Mark Doran has been all over the place. He's been on Markham Hislop's Energy Media, Real Talk with Ryan Jesperson this morning. And this story has hit the New York Times again. So again, this Alberta has a massive, massive problem, as Mark Doran helps us remember. There's not many jurisdictions with as many holes in the ground as what Alberta has, just the way things work out. So please remember to go to cleanupyourmess.ca to follow that. But we are planning a few town halls in Provost, in Calgary Northwest, and in Airdrie. Stay tuned for those. I'll give you the details once they're final. As I've been mentioning, the Public Interest Alberta Common Purpose Collective Action Conference is on May 8th and 9th. And please mark your calendar for May 29th. It's the Alberta Day of Action that is being led by the Alberta Federation of Labor. please go to their webpage to find out about more and to spread the word for it. Okay, and without further ado, I want to get right to my conversation with Seb. So Seb Kennedy joined me. He's an energy journalist turned market analyst. He's transitioned from covering renewables to focusing on natural gas and LNG markets, and he launched Energy Flux to provide those insights. Our discussion highlights the volatility of the LNG market, exasperated by the geopolitical events such as the Russia-Ukraine war and the US attacks on Iran that have led to the closure of the Strait of Hormuz, which is the focus of this conversation. So Seb shows the significant supply disruptions to the oil and gas commodities and other global commodities, including fertilizer and even chip making, which is fascinating. With this, Seb then takes it back to Canada and outlines why investment into LNG in North America, particularly in Canada, are quite risky despite the short-term economic windfalls that are clearly present today. So investing in renewables and reducing our reliance on fossil fuels is becoming more and more apparent. You can also please check out the conversation I had with Jody McPherson about AI data centers and even their security risk as well. And I forgot to mention that my conversation with Michelle Robinson is out too. So please check out Native Calgarian podcast on treaties to hear more about that from Michelle. We had a great first conversation about what treaties mean, what sort of obligations we have. Okay, and if you'd like to know more about Seb, please follow him on energyflux.com. I'll put the links to all of his media and his socials in this post when I put it on Substack. And with that, I will get this going. So Seb, I'm so pleased to have you here. So I started following Seb back in, I think it was October of last year, when there was a LNG conference in the United States. And I've seen you on Markham Hislop's Energy Media. Is it a couple times or a few times, Seb?
Yeah, a couple of times.
Okay, that's what I thought. Right. So can you just start with your background a little bit, Seb? Let people know where you started and what you're doing today, please. Thank you.
Sure. Thanks for having me on the show, Jenny. Pleasure to be with you. I'm a journalist by trade. Energy journalism is where I started my career. I've spent the first decade of my reporting career, working the renewables beat and phoning up contacts and landing scoops. So I cut my teeth in that trade. Then I branched out and I spent a few years working for a natural gas consultancy, where I learned all of the kind of inner machinations and economics of natural gas and LNG, liquefied natural gas. I felt like it was a kind of very poorly understood section of the energy market that required a little bit more understanding, because it's so influential upon the rest of the energy stack, particularly in Europe. So I launched Energy Flux principally to achieve that, to shed light on how gas and LNG work, and to inform readers with kind of data-driven chart decks and deep dive feature articles about trends in gas and LNG, then their kind of wider impact on the economy and vice versa.
Yeah, fabulous work. And you're right, it's such a gap. I was mentioning to you offline that as a geophysicist, we don't spend much time thinking about how gas gets to market and how the whole system works in terms of supply and demand. And what really caught my attention about your message back in October was just what you could see in terms of the supply and this, you were describing for me this flip that is expected to be happening in terms of an oversupply and quickly to an undersupply scenario. So can you back up for people and help them understand where were we at the end of last year and what was the natural gas market looking like? Thank you.
Yeah, it's changing very quickly. So it's good to rewind and remember where we're at. I think a useful place to start would actually be going back to 2022 and Russia's invasion of Ukraine, or its full invasion of Ukraine. when, of course, Europe was deprived of pipeline gas from Russia, which supplied the bulk of its natural gas needs. And when those pipeline volumes were curtailed, then Europe turned to liquefied natural gas to bridge the gap. There was an awful lot of demand destruction, so a lot of natural gas simply wasn't burnt. But the demand segments that were not able to go without, so heating and power generation and some industrial uses, they turned to LNG for their supply. That demand placed onto the LNG system triggered an enormous investment wave in new LNG supply. And these investments take a long time to percolate through the system, to develop, to achieve final investment decision, begin construction, and then start operating. So as a result, we have this enormous wave of new supply globally, mostly from the United States, but also from other places, including Canada, which is going to incrementally increase the amount of supply coming onto the market at a rate that will far outstrip even the most optimistic projections of the ability of demand importing countries to soak up that supply with demand. So supply is going to outstrip the demand. So we're all expecting a looser market. At the end of last year, everybody was talking about the LNG glut, the excess LNG that's going to be in the market, and how we were expecting 2026 to be a pivotal year when prices came down to a point that stimulated new demand to come and absorb the excess. And then war in Iran breaks out, the unthinkable happens, and the Strait of Hormuz is closed. So suddenly the LNG market, which was kind of bracing for this structural oversupply, lost 20% of its physical supply overnight, which instantly tightened up the market. And so this whole narrative around the glut has been, at the very least, delayed by a year or possibly more, depending on how long the world has to live without LNG from Qatar, principally, but also the United Arab Emirates. So globally, we've gone from this kind of scarcity to anticipation of a glut to massive scarcity within the space of 4 years. It's been a real roller coaster. But the crazy thing is that all that LNG supply that's going to come onto the market, it's still coming. And if anything, the crazy prices we're seeing now as a result of Iran, the war and the closure of Hormuz is going to destroy more demand, which means that when the LNG supply wave finally breaks, you could see extremely low pricing again. So it's very, very volatile, very jaggedy, this market. There's never in any kind of equilibrium or balance. It's always very volatile.
Yeah, fabulous account, Seb. I want to back up and talk about, as you said, this supply constriction to Europe when the Ukraine war happened and the impact that had in terms of prices. Also investment, if you don't mind, because I sort of forgot you were also a renewable expert, just expand a little bit on what happened to that demand, because as you said, this was a natural gas demand going into an LNG market demand, which is an increased price scenario, not a decreased price scenario, because it's more energy involved in creating that supply. But can you speak about the renewables that were also picked up because of that? Because was there not also a demand destruction based on that cost differential at that point, Seb?
Yeah, so one of the major policy responses to Russia's 2022 invasion of Ukraine was the release of Repower EU. So the European Union issued a package of policy measures designed to reduce as far as possible natural gas consumption in all areas of the economy. So principally in power generation, because that's the easiest demand segment to replace gas, because you can produce solar and wind and store it with batteries much more cost effectively than burning gas in power generation stations, especially when the wholesale price increases by 5 times, which it did in 2022. And so to have it in the kind of triple digits was totally unprecedented. And we're a long way from that for now, but we could go back to that place. And when prices do that, then it's just not economically viable to burn gas in a power station. There are alternatives. Anything is cheaper than that. So, using renewables, obviously zero marginal cost, but also coal. So coal will become more competitive in the power sector when gas becomes more expensive. And we're at risk of that happening again, going from gas to coal, which obviously is more emissions intensive. So this is bad for the environment. And the other thing to consider is that when prices go this high, or as high as they did in 2022, and if they go back to that place, then anybody who actually has gas, they're incentivized not to use it. Because if let's say you've got a long-term supply agreement, you're a ceramic manufacturer or you're a steel smelter, and you've contracted gas at a really low long-term contract price, and the price in the spot market goes way above your contract price, why would you burn the gas? Because the amount of money you can make from your end product, whether it's steel or ceramics or fertilizer, is not going to be the same profit margin as you get from just reselling the gas into the spot market. So actually industry shuts down, even though it might have access to cheap gas, just because it makes more sense to trade the gas and sell it to somebody else who is in urgent need and has to supply the gas to their users, like a utility for heat, if it was the middle of winter, for example. So all sorts of strange things happen in markets when these big differences in price emerge, and almost none of them are good for consumers. And that's the full stop point, is that the consumers always backstop all this crazy pricing.
Right. Well, and that's what we're experiencing right now. I had a friend last week saying, how can I look at the prices in the gas station and not wonder how that, or why that price is going up, and think about as you said, this war that's going on in the Strait of Hormuz closure. So maybe that's a good place for us to start looking at that, Seb, if you don't mind. But I do want to just underscore what you were saying, which is long-term investment has really seen a volatile market here. The supply and the demand are uncertain, as well as the price. It's been so volatile, and volatility is not a good thing for long-term investment. So all of those things considering, I would also like to then talk about, as you're going through this, how quickly things can change. Because if you shut down Qatari gas, for example, and try to switch to US, it's not like that can happen overnight as well. So maybe as you're walking through the map, if you can elaborate on that as well, Seb, would be fabulous. Thank you.
Yeah, sure. Okay, so this is the Strait of Hormuz. It's a very, very tight waterway. Its narrowest point, it's about 20 nautical miles, 20 nautical miles. That's very narrow waterway, and commercial traffic, oil tankers navigating through this choke point have to do a kind of 120-degree turn. So they have to slow down to a single-digit knots speed in waters that are sailing extremely close to the coastline of Iran, which is extremely well defended and armed. And in normal times, then the traffic flows through here. You've got up to 30% of global seaborne oil trade, and about 20% of global LNG is flowing from the Middle East, from these Middle East suppliers out through the Strait of Hormuz and into global markets, mostly heading to Asia, some of it going to Europe, either via the Red Sea or through the southern tip of Africa. And it's not just an energy story, although we're right to focus on energy because that's the most immediate impact. But on the right, I just added a list here of other commodities that are non-energy commodities that flow out through the Persian Gulf, through the Strait of Hormuz. And we're looking at, 30 to 40% of ammonia and urea, which are critical inputs to fertilizer and other chemicals. Helium, which is essential to chip making, medical imaging. Sulfur, again, vital for fertilizer mining, metals processing, so that could have an impact on things like copper and other metals. Uranium extraction too, so nuclear fuel is implicated here. Methanol, polyethylene, vital for packaging, bottles, plastics, propylene, aluminium, and phosphate, and so on. So you can see that this is not just an energy story, it has a kind of whole economy potential impact. This closure, and the longer that the global economy has to go without these exports, then the higher prices of all these things is going to rise, until you see prices rise to the point where you see more demand destruction occur. So for oil and for natural gas, then you'll see things becoming more expensive at the pump, electricity. But for all these things over here, you're looking at like fertilizer becoming more expensive, and we're coming up to the food planting season. So if fertilizer becomes more expensive, that has implications for crop yields later on in the year. Chip making could become more expensive or have to halt. The production of packaging of all sorts, that just affects kind of every consumer good you can possibly imagine. So the potential economic impacts on a global macro basis are very profound. There's only a certain amount of time that Hormuz can stay closed for before these things start to trickle through. And arguably the impact, because of the outage and the risk of potential conflicts in the future, remains present. Then there's no guarantee that shipments will begin immediately, because the war risk premium, the insurance that underwrites these cargo shipments, became unaffordable in the outbreak of war. And for as long as the insurers perceive this risk to be material to ships passing through here, then they won't underwrite those shipments, so the shipments won't be able to sail. So it's a major constraint. It's no easy way, first of all, to end the conflicts, but then second of all, to assure commercial underwriters that the risk has actually been reduced or gotten rid of. The similar thing happened in the Red Sea, which I imagine we're going to talk about later, but I thought that gives a kind of good overview. And I do have I can find a little video somewhere. There's a little thing, just shows you what happened to the tanker traffic. So this is the tanker traffic moving through the Strait of Hormuz before the invasion, and then after the 28th of February, then we saw the traffic really just slow to a trickle as everybody dropped anchor either side of this constraint.
Right. That's something I caught on 60 Minutes, did a segment with this. Thank you so much for this yesterday. And I caught them talking about the stranded ships, because that's the other thing I didn't really think about is, of course, there were still ships on route. Like, these routes are not something that happened overnight. So, you know, there's weeks of travel happening before that. And now they're stranded on either side of this. And as you said, it's run by civilians. So I've heard the President of the United States suggest that they would have armed ships going through there. But as you described, this remarkable narrow channel and the turn and all the things that would cause, well, and of course the armed nature at this point, just not possible. So thank you so much for walking through all of that logic for us. Yes, if you wouldn't mind also expanding into the Red Sea a little bit, because that is the next shoe that we are expecting to potentially drop here as well. And it has been closed in the past. I'm not sure if you're able to speak to that too, Seb.
Yeah, absolutely. So what we've seen is that in the wake of Israel's offensive against Gaza, then the Houthi militia, who are mostly present in Yemen, which has also been at war with Saudi Arabia for several years now, it tends to go forgotten about. The Houthi rebels, out of solidarity with the people of Gaza, launched an initiative where they were essentially seizing at gunpoint commercial vessels sailing through the Red Sea. And because the risk of that to commercial traffic became intolerable, then vessels just avoided the Red Sea. And so we saw transits through the Suez Canal also slow down to a real trickle, because it was just kind of safer and ultimately lower risk to go all the way around the southern tip of Africa to get to Europe. So we saw Qatari LNG, for example, leaving the Persian Gulf, going all the way around the Cape of Good Hope, it's called, and then up the other side to get to European markets. Now, what's interesting is that with the closure of the Hormuz Strait, Saudi Arabia has started shipping oil internally within Saudi Arabia from the east coast to the west coast. So Saudi Arabia, obviously, it has these two gulfs on either side. It has the Persian Gulf on the east coast, and it has the Red Sea on the west coast, and it has this east to west oil pipeline. So they anticipated at some point geopolitics would result in the closure of Hormuz. They commissioned this pipeline to get the oil out through the Red Sea. But there are two problems here. One is that the pipeline can only carry a tiny fraction of Saudi oil exports. So even if they get this east to west pipeline operating at full capacity and loading at the port on the Red Sea side, they're still not going to be able to replace all of their volumes that are lost through the closure of the Hormuz Strait. And then you've got the problem of the Houthi rebels, who could at any moment restart their campaign of disruption in the Red Sea. Plus, Iran itself is now striking oil loading terminals all over the Gulf area. Saudi Arabia, from the east to west pipeline in the Red Sea, would be loading oil through a port called Yanbu port on the Red Sea. If that gets struck, then the whole east to west pipeline concept kind of becomes irrelevant, because you haven't got a loading point. And there is recent precedent. Just yesterday, I think it was, the Iranians struck Fujairah port. That's a port in the United Arab Emirates, which is, the UAE actually has territory that's on either side of the Strait of Hormuz. And this Fujairah port is absolutely critical because on the other side of the constraint. So United Arab Emirates was able to keep exporting oil beyond the strait by piping it through to Fujairah port and loading tankers there. That port is now up in flames, and its ability to load tankers is severely compromised. So Iran has the reach to be able to strike oil loading terminals all over the Gulf region, which it's been doing as part of its kind of asymmetric warfare campaign. So there's no easy option for getting around the Strait of Hormuz bottleneck.
Wow, that is fascinating. And actually, it rings a little bit true here in Alberta, because TMX is only a fraction of our production as well. And so to think of, if we needed to move more one way, as we've been talking, that we don't have the capacity to do that. But most importantly, this is becoming more and more apparent that any centralized power or energy system is at risk of geopolitical strike from either side. So it's becoming a weapon of war, it seems. Well, not it seems, it is. So the demand destruction, as you're saying with that. But the other thing I also want to underscore, something you taught me here, is the fertilizer prices and the access. I mean, I knew that fertilizer volumes are going to decrease, but are you also suggesting that that is a price choice, or is that's going to be an actual volume reduction to reach North America, for example? Like, it's my concern is, I've heard that there might not be fertilizer for planting in North America. Is that a physical constraint, or is that a choice in terms of selling of natural gas for certain purposes?
So, I mean, this is not my area of expertise, fertilizer, but I'd say that, first of all, rich nations very rarely go without. They just pay more, and they outbid those nations that are unable to compete. So
Gotcha.
We've seen this in natural gas, and I imagine we'll see it with other commodities too. It becomes a battle of the balance sheets. The more you're able to pay, the more you're able to secure your supply. And if there's any economy that would be able to outbid others, then I would imagine it'd be the United States. That being said, when you outbid global competitors in a race for commodities, then you have to pass those prices through to consumers. So that will be the farmers who pay more for their fertilizer, who then have to charge more for their crop yields when it comes to harvesting time, which feeds through into the price of fresh fruit and vegetables in the grocery store. And this contributes to the possibility, along with all the other material impacts of this constraint, of there being a kind of energy stroke commodity shock, which triggers an inflationary spiral. Because if this, in the wake of the Ukraine war, we saw this. We saw there being massive inflation across all consumer segments, and then central banks having to hike interest rates to tame inflation. If that happens again, then it has major implications for the stability of the global economy. We could be, in a kind of recessionary environment, which has all sorts of implications for onward investment across the economy, for workforces that are dependent upon these commodity exposed sectors of the economy. So, the economy is already in a kind of precarious state as it was. This has the potential to have far reaching consequences for consumers, both in the United States and across the rest of the world.
Yes, thank you for stretching a little bit beyond your expertise there. I really appreciate it, because I do see those secondary impacts being so significant. When I think about even the oil sands production here in Alberta is dependent on so many inputs and consistent input volumes. So those impacts, I think, will be reaching here as well. Can you speak a little bit about what this means? And if you wouldn't mind taking it back to North America for folks, is to talk a little bit about what should this mean for us in terms of LNG investment here in Canada? How do you see it impacting what you knew at the beginning of this year? Thank you.
Yeah, so it's very much a double-edged sword, because the immediate economics of LNG supply have been massively boosted by the increase in the sales price of gas in Europe and Asia. And, you know, with prices racing towards sort of $20, then what you're really seeing is massive windfall profits for US LNG exporters. And that would be the same for Canadian LNG exports too. If they're able to capture the arbitrage between the cost of production and the sales price in a crisis market, then the windfall profits are phenomenal. My calculations for Energy Flux estimate that in the first month, assuming that the Hormuz closure lasts a month and energy prices stay at the kind of gas prices stay at the level that they're currently at, then you could be looking at about $4 billion of windfall profits. That's just profits in excess of what they were able to achieve before the war. So this is just excess profits on top of the previous profits. So it becomes a much more attractive investment if you look at things through that kind of narrow time frame, which is just like, well, right now, yes, LNG is very profitable. So the economics of investing in LNG become attractive if you don't take into account the kind of longer term picture. And that's where things become extremely complicated. And we go back to where we started at the beginning of the conversation, with this LNG supply wave coming downstream and massive demand destruction potentially occurring as a result of these high prices. So the investment case for LNG Canada, like in the second phase, which has been talked about by Shell and its partners, is very much kind of facing that question. It's just, is it a viable investment? Can you make an investment in that project based on crisis pricing? Probably not, but Shell itself is very bullish. It thinks that demand is always going to rise to the occasion, that there's really kind of no limit to demand growth at the right price, and they're confident that they can build the project at a kind of low cost base that would mean it's profitable to sell into markets no matter how low the price goes during the operation of the plant. I think that's a really brave assumption to make, because the delta of uncertainty is so enormous over how markets will respond, not only to the current crisis, but also to this kind of massive supply wave that's on the market. It's incredibly hard to say that, yeah, LNG Canada is going to be a great investment and it's going to be a good thing for Shell's shareholders. And the other thing about LNG Canada is that it's actually been not very successful on a technical basis. So since the plant has been under commissioning and starting up, then we've seen lots of ramp-up problems. We saw a partial shutdown of Train 2 in October. There was a power outage in December. And actually just this month, it's in the news now, there's a full shutdown of the plant. And these outages and shutdowns are really problematic, because in order to control the well pressure, they have to flare off more gas to stop the pipelines from exceeding operational safety parameters. And that means more flaring of gas, more emissions, more pollution in an environmentally sensitive part of the world. And that really undermines the public and political consensus for expanding the facility to, which would have said it kind of implies a kind of doubling or tripling of these potential blowouts when they happen, these kind of emissions blowouts. So yeah, it's a real open question. I think the industry is obviously trying to capitalize on this moment by saying, well, if we had more LNG, then we'd have lower prices and we'd have more insulation against these shocks. But the buyers have to buy in, they have to underwrite these projects. They have to say, we're willing to buy into this project with a 15 or 20 year take or pay contract, where we will pay for the cargoes and then enable the finance to go into this plant and enable you to build it. Or Shell has to take a view that it's going to find buyers at the right price no matter what. And neither of those things can be guaranteed. So it's a brave stroke foolhardy thing to be doing, to be investing in more liquefaction capacity at this kind of late phase in the liquefaction investment cycle.
Yeah, fabulous summary there. What I pictured, Seb, and working in the industry back in the downturn from 2014 to 2018, I used to describe the investment as taking a bigger piece of a shrinking pie. And that's sort of what I'm picturing when you talk about demand destruction through these physical limitations in the system. As those prices increase, as you said earlier, it falls on the consumer. And that becomes more and more apparent for us to flee to other resources. And especially like we we're saying with the now security and safety risks around these resources as well. So many things working against that. But then you also rightly brought in the technical merits of these projects, because I read recently that that facility is flaring sometimes 15 times more than what it was specified for. And of course, as you said, there is also venting going on. That can't all be burned. So when you spoke earlier about coal, going back to coal in some cases, that's where people argue when you look at the facts on the ground, it is actually a cleaner source of energy because it doesn't have those oopsie type scenarios. And one thing I do want to get into, I was mentioning with you, I want to speak with Sharon Wilson and Justin McCulka with Oilfield Witness, because again, like these gases have water with them, and there is a physical constraint in the facilities that require these blowdowns, they're called, to get rid of that excess pressure and liquid problem. And that to me is the overarching methane, the big numbers. Those are the big volumes that come out of the system, and that's what's not being accounted for in these specifications of these facilities, and ultimately the ability for us to meet market demand if there was one. So many things I see in there that are just gaps in the assumptions. And as you said, this glut of investment that's already occurred, it doesn't make sense to me to take more risk without knowing what's happening with that existing stuff. And then, as somebody who is very concerned about global warming, to those facilities, in my view, should be shut in until they are properly addressed with those releases that it wasn't specified for. So I guess just to close here, Seb, can you touch on some of the investments where you think that we should be looking to? If you were mentioning that the Alberta government looks to your Energy Flux paper. Can you help us see what are you seeing in terms of growth, stable growth, energy investment, if you will?
I don't provide investment advice, but I present the data upon which governments and policymakers can make decisions and take a view about what makes strategic sense. And I think overwhelmingly then, if the assumption borne out by recent history is that natural gas and LNG are going to be subject to intense commodity shocks driven by geopolitical instability, then hitching your economic security, your economic fortunes to the vagaries of that commodity cycle are questionable, because the overarching impact or the overriding impact of these price spikes is borne out upon consumers. And those consumers that reside in energy economies that are overwhelmingly reliant upon imports, upon commodity imports, upon natural gas imports, are the most exposed. So I think it's not a controversial thing to say that reducing natural gas exposure, reducing natural gas consumption in all economic segments will pay dividends over the long term. So that would mean, renewables replacing gas in the power generation stack, but enabling that, you need grid upgrades, grid infrastructure. I think that the renewable story has tipped from a place of just more generation to facilitating flexibility, tariffs for consumers that reward those who can make their demand flexible, who can flex their demand into periods of renewables oversupply and flex down when renewables are not available, massive infrastructure investment in to enable storage, to be able to kind of time spread the generation, push it into like the night, push solar into the night, push wind generation into still periods. That all needs to happen. There are constraints that are going to arise from this commodity shock, because obviously these things need to be built with stuff, with material inputs, with energy inputs. And when those things become more expensive, then the upfront cost of renewables is going to increase. Not to mention, if you do have rate hikes from central banks, then the cost of finance, which is probably the most critical factor when considering renewables investments, is the cost of finance. So if we see these rate hikes that I fear could be coming, then that is going to complicate investments in renewables. But my concern is that we get more short-term views being taken from decision makers that, oh, well, if that's more expensive, then we just need to kind of produce more gas to get the price down now, when all it does is kind of bake in this reliance, this import dependence, which perpetuates exposure to the next commodity cycle. Whereas the kind of wise, long-term strategic investment would be to obviously reduce that exposure and make the necessary investments on the demand side to protect consumers from the worst effects of exposure to commodity volatility. I think that's the kind of overarching message, is that these long-term investments that reduce exposure are going to pay dividends for economic security, sovereignty, resilience, and industrial competitiveness, particularly in a place like Europe, which is so hopelessly reliant on natural gas, and now LNG, having lost Russian gas, it's in a really parlous state. And despite the best efforts of the European Commission, it's just not happening fast enough. And it's like lots of people are saying, how many wake-up calls do we really need? 2 within a space of 4 years, 2 natural gas shocks. You'd hope that now is the time that this transition really gets put onto steroids, and it just accelerates beyond the point of no return, so that we can really kind of turn the page on this import reliance segment of Europe's industrial history.
Yeah, fabulous. I can't help but imagine that we are going to be having a very different conversation even in 6 months from now, Seb. Thank you so much for your time on this. I just picture that, looking to Cuba as an example right now, the exposure, well, they're being cut off from fossil fuels, and the renewable boom that's happening there, of course, out of desperate need. So I think there are many examples of this, Pakistan being another one, where these rapid expansion of renewables can be done in short order when the need exists. I think that we'll be seeing a lot more of that based on what we're seeing in the Strait of Hormuz right now. I'm super grateful for your sharing those insights with us, Seb. How do people follow you, just before we end? And if there's anything else you wanted to add, please do before we do.
Yeah, no, my pleasure. Thanks for having me, Jenny. So the best way to follow what I do is to sign up for the Energy Flux newsletter. Go to www.energyflux.news, and there's a link at the top. Just click to sign up for the newsletter. There are various paid tiers and things, but I give away lots of commentary for free for readers to get an understanding of gas markets. And if you want to go deeper, then I have paywalls, chart deck, deep dives, hot takes. There's even a podcast of my own, and there's a private members forum. So there's lots of kind of digital angles to explore on the Energy Flux platform, and you can also find me on LinkedIn and Blue Sky and other places.
Yes, that's where I found you, was at LinkedIn. But yes, I'll make sure to include your socials and your links as well in this. Thank you very much for your time, Seb. I really appreciate the knowledge, and I think I need to start following you more deeply, because yes, I did see that you have. Is the podcast available to everyone?
Yeah, it's freely available. I take questions from listeners. They kind of prioritize paid subscribers, but the podcast itself is free to use.
Fabulous. Excellent. Okay, well, thank you again so much for your time. I really appreciate it, and we'll talk soon, I hope. Thank you.
My pleasure. Thank you.